I'm gonna separate that maybe from other places. In macro, the best macro managers, the absolute best macro managers in the world are 60% right, 55 to 60% right in any trade in one market in 1 month. Just think about that. Like, at a high level, that's not very good. That's actually pretty bad in the scheme of things, right? Relative to like what the world considers expertise. And so part of what you have to do, because macro is so imprecise, right? Since your signal to noise is so low, is what you do is you have to create a lot of bets. Because if what you do is you have 20 bets that are 55-45 with a reasonable amount of reliability, 55-45, actually you can build a 1 to 1.5 gross to fee Sharpe ratio. And if you do that, you'll build the biggest institutional asset manager, the biggest hedge fund in the world, right? like think about that. That's what it takes.
Fundamental law of asset management. Absolutely. Yep.
Right. But the trick is diversification. Like that really is the trick in the macro sense, which is, I was trading currencies. There's 50 major liquid exchange rates that are out there. And like the idea was try to get yourself to 55-45 or even 53 or 54. If you can get yourself at that point and get enough diversification, enough balance, enough things like that, you can actually do something that's pretty good. But if you looked at any one of the things, you'd kind of be like, kind of garbagey, right? Like not that good.
Yeah.
And so that's kind of the, just get that coin in your favor.
Yeah. No. We hammer that drum all the time. That if you look at any of the individual edges that we use, that the size of the edge is vanishingly small. If you look at all of those edges applied to a single market, it's marginally better. If it's only when you apply all of those edges across all of those markets at a trade frequency, a sufficient trade frequency that balances, your edge against the friction, right? The cost of having to trade, that you actually are able to generate the 1.5, 2 Sharpe ratios that everybody, is looking for, and so few can deliver. But diversification is such a huge,
it's a huge
part
thing.
of that. Yeah.
And I feel like the Twitterverse or the popular media, like everyone is like, I don't know, is the Fed gonna pivot in June or not, or whatever, July? Like that's one bet. Like that, genuinely, that's how I look 100%. At that. It's like, I don't know, I think probably not, but like that's about how good it is it's like one bet, one bet of ideally, hundreds of bets that you'll have on over time. And so like, also on the flip side, whoever calls that bet right, like recognize that the odds that they got lucky are at least 45%, right? There's the odds that they got lucky, because if they were the best in the world, the odds that they got lucky were 45%, right?
Yeah, right.
More likely, the odds that they were lucky are something closer to 50%. And so also it's about looking at the process, to understand whether, if run over enough sample size, you're going to get something that actually works through time.